You thought qualifying on just the property's rent was a good deal. No W-2s, no pay stubs, no tax returns, just the property's rent. Qualifying the payment was the best kept secret in real estate investing. Now, what if I told you you didn't need either? No rent, no ratio. On today's episode, we're going to cover the DSCR no ratio loan, what the investors look for when using this no ratio loan, how to pencil out the numbers, and how much is this going to cost you, and when to use it when you need to save the deal. Let's get into it. I'm Ryan Marks, host of the SCI Mortgage Channel, and we are dedicated to those of you who are self-employed or real estate investors looking to build your portfolio and don't fit into the traditional big banks lending box. And if you get any value out of these episodes, please hit that like and subscribe button. We're just here to put out great content dedicated to the non-QM space as you navigate through the wild world of self-employed and real estate investing. So let's get right into it. So most of you probably already know half the problem. The majority of these properties currently available on the market don't debt coverage. That could be due to a numerous amount of reasons, whether the property is distressed, you're finding a good deal, but you just don't have what the fair market rent is that's needed in order to break even or positive cash flow, or you may own a property yourself that you're currently renovating, or you're in fixed rents where the tenant is paying less than the fair market value and you just can't use the debt coverage ratio in order to cash out funds out of that property, whether that's a new first or a fixed second. So this no ratio loan program has actually been around for a while. It's not something new. It's just not utilized as much as I think it can be, or talked about, depending on which lender that you're working with if you're trying to purchase these investment properties. And a lot of that has to do with everyone's typically aware that if the property doesn't debt coverage at 1 or greater, there's still a lot of financing available down to 0.75%. But when you get to that 0.74% and under, that is a true no ratio debt coverage. So we'll talk a little bit more about that, but let's get into the numbers on what that looks like. So this is a recent example of a customer's loan that we did where they were purchasing a standard single family residence with a purchase price of $500,000, and their intention was to put the standard 20% down payment, and after taxes, insurance, principal, and interest, they needed that payment to debt coverage a 1 or better. But unfortunately, this property was vacant and it did need a little TLC. So when we went to do the rent comparables, meaning the appraiser went out, found rent comps, gave us 3 of them, and then we take the middle of the road, that number was not high enough for us to debt coverage. So once you take the down payment at 20%, which was $100,000, so you had a loan amount of $400,000, this particular loan had a 7.375% interest rates. So we're not quoting rates on this episode, but given this particular scenario, this was the interest rate associated on this 30-year fixed loan product, and that gave us a principal and interest payment of $27.6270 using $520.83 for taxes and $150 a month for homeowners insurance. Our all-in payment was $34.33.53. Unfortunately, when we got the rent comps back, the average rent that came in on the comparables was just over $1,700, which essentially gave us a 0.5% debt coverage ratio, well under the 1%. So normally this is where you stop looking at this transaction. You're going to hit a roadblock. The lender that you're likely working with is going to tell you a few weeks into the transaction, sorry, we went below, 0.75. We didn't qualify you at a true no ratio loan product. So now you're left with either further increasing the down payment in order to debt coverage or using the no ratio DSCR loan product. This is a perfect solution in order to provide financing so this borrower does not have to walk away from this property. Now, there's a few things that you have to understand when using this loan product. On a standard 20% down payment, you're going to receive more competitive interest rates, and often there is no reserve requirements and a lower credit score for barrier of entry to qualify for financing. When you use the no ratio product, number one, minimum, you have to have a 25% down payment in order to qualify for the no ratio loan product. Because you're using a different method to qualify, the investor has to weigh the risk of the loan. So by increasing the down payment, you've got further skin in the game. You have more equity in the property at that 25% down payment or greater. And in addition to that, you're going to have reserves. So that means you're going to have a certain amount of funds available in another financial institution that you can show that you have the ability to make payments if you're not getting enough rent to cover that mortgage payment, or if the property is completely vacant and you're having to make that monthly payment yourself. And the last thing is the interest rates are higher when you're utilizing the no ratio loan because, again, this is based on risk. So you're going to pay a little more in rate in order to use the no ratio loan product. But this is another one of those times when utilizing that prepay lever, which we've talked about in other episodes, can further drive down that interest rate to give you something more competitive. So it's important to understand that if you do utilize the prepayment penalty, what your long-term plan is. So if you know that if you can get the interest rate that you need now in order to close the transaction while you work to bring up that fair market rent or get the property occupied, what is your debt coverage ratio going to be once everything is leveled out and settled? That is an important conversation that you have to have with the lender if you're not working with us, because we will most definitely be talking about what the 2 to 5 year and beyond plan is for this particular property. So just to recap, if you are going to use the true no ratio DSCR loan product, meaning that your property does not debt coverage at least 0.75 or greater, you're going to need to put at least a 25% down payment. You're required to have a higher credit score, and you will need reserves to cover payments just in case you cannot make that mortgage payment. But a lot of the other things still remain the same because this is falling in the residential 1 to 4 unit. You're welcome to vest the property in an LLC or another entity. You can use the 30-year fixed adjustable rate mortgages, the 40-year IO, and tons of other products that you can use to kind of pull those levers. And if prepayment penalties are offered in your market, you can utilize those as well in order to bring down those costs to make sure that whatever the loan term is that you currently have, if you're looking to utilize it for the long term, it works once you've righted the property and you're getting the maximum rent for that unit. And if you currently are under contract right now on a property and you've hit a wall where your rent just doesn't quite debt coverage, feel free to reach out to myself or the team. We would be more than happy to go over if this is a solution so you can hang on to that property, put it into your portfolio. And if you want to run your own DSCR numbers, you're welcome to head over to sceimortgage.com, where we have great tools and resources available and ways to get in touch with us. Until next time, remember to let your income work smarter, not harder.